Hey everyone, thanks for joining me today. My name's Chris White. I'm an investment analyst with 5i Research, and today we're going to be going over the details of what happened at Silicon Valley Bank. Silicon Valley Bank was a roughly $17 billion company that vanished in a matter of days. Let's dive into why this happened. Silicon Valley Bank, SVB, was a bank that took in customer deposits, mostly from tech and healthcare companies, paid a relatively low interest rate on these deposits, and earned a higher interest rate on fixed income securities that it bought using these customer deposits. This is the business model for most banks. What we saw with SVB was a combination of a few factors. First, the aggressive monetary policy that the U.S. Central Bank, the Federal Reserve, took in 2022 caused individuals and companies to realize that they could earn a higher return in money market funds than in a checking or savings account with a bank. This factor, combined with tech and healthcare startups facing a difficult funding environment in 2022, led to a steady outflow of customer deposits in 2022 and early 2023. On top of that, the rapid rise in interest rates caused bond prices to fall the most in several decades, causing the unrealized bond losses on SVB's balance sheet to balloon higher. Here we can see that SVB had unrealized losses on its bond portfolio of almost $18 billion, which was the size of the company's equity capital before it fell. And for every 1% increase in interest rates by the Federal Reserve, the bank would have lost another $6 billion. This is particularly troublesome when 55% of the company's assets were its bond portfolio, and its remaining liquid assets weren't enough to cover the sustained customer withdrawals that we saw at the bank. When news broke out that SVB had to sell some of its bonds at a significant loss, customers became concerned about its liquidity and began withdrawing at a rapid pace, taking out $42 billion by the end of the day on the day that it collapsed. What we have here is not just a classic bank run, but a bank run fueled by systemic depositor withdrawals and unrealized bond losses as interest rates remain high. There are new funding programs in place to help stem these concerns, but there is a continued issue of depositor withdrawals as competing rates in money market funds are too attractive to pass up. Okay, everyone, that's it for today. Thanks for stopping by. And please remember to like, subscribe, and share this video if you found it useful. And head to the 5i Research website where members can ask questions regarding individual stocks or the market, find research reports on Canadian companies, receive bi-weekly newsletters on the market, view analytics on their own investment portfolios, and much more. Thanks again for watching, and we hope to see you next time.